Hello, thanks for joining this live Q&A. I hope you can all see me. So as this is a test, maybe you could respond to me and say if you can actually see me. And otherwise, we jump straight into our Q&A session. And there is a question from Chian here. And she asked me, what is the most challenging part of quant trading? Now, this is a very general question indeed to start with, and I would just like to answer that. Well, it really depends on what part of quant trading you're in, and there's a big difference. For example, if you work in a big firm such as J.P. Morgan or Goldman, or in a small hedge fund or prop trading firm. Why is it different? Well, basically, if you work in a big firm, for example, you have a lot of access to many, many different tools of live trading and data, for example. So when you think about this as a normal retail trader, it's actually very difficult to get really good data. And the further you go up the ladder in the companies, the easier it is to access really good market data. Now, I know from my friends that work, for example, in really small hedge funds, a lot of their time, even though they're quants, is spent building web scrapers and web monitors to access the data, whereas in big firms, they have all the Bloomberg and the Reuters and all the other terminals in order to access the really good quality market data, because they simply have the financial power. So that's definitely a challenge for the smaller firms getting good data. Of course, there's other challenges. So for example, if you're a quant but not necessarily a programmer, often building complex programming environments can be quite challenging. So you might actually build a really good system in your quant analysis Jupyter notebooks or so. But if you then try to implement this in a real life trading environment, there's a lot of hoops to jump through, and programming here could be quite a challenge. So as you see, there's a lot of different possibilities what could be a challenge, and there's no clear-cut way of doing that. So there's another question here. What is the number one fatal thing that could diminish your trading portfolio capital? Well, again, there is quite a lot of things that could go wrong with it, and probably all of you heard of some of them. There isn't really a number one, but I will just tell you a few. So one is when you build your quantitative systems, of course, you can fall for one of the biases that are in trading, such as overfitting, look-ahead bias, survivorship bias, and all these. And when you look this up on the web, you will find that a lot of people talk about these all the time, and it's very easy to fall into them. And quite often, and frankly, it's actually, in my opinion, not possible to completely avoid all of these biases. At some point or another, you will just simply be subject to one of those, and there is not much you can do about it. Now, there's a lot of other problems as well, and if you are a quant developer, you will probably notice that. So if you build, say, an automated trading system and you build the execution, there is quite a few things that could go wrong. So, for example, if your trading system gets into a strange loop, suddenly you find yourself having thousands and thousands of limit orders sitting in the market that you didn't intend to be there. And if you do this, then quite often your machine won't help you to eliminate them again, and you would have to go and click and close them all by hand, unless you have already built a system beforehand that saves you from that. Another thing is, especially if you trade fast, you have all your orders in the market, and suddenly the connection to the exchange or the internet crashes, or your server crashes, and you can't do any trading for some time. And I've personally seen this in several firms. And suddenly you have all these all these orders in the market, but there's nothing you can do to close them. There's nothing you can do to change them or anything. And you can only wait to get back to where you were once the server's up, the connection has started. So that's very dangerous as well. And you got to be really, really incredibly careful when you do these, when you write these programs, especially if you use limit orders, to avoid these things. And usually what you want to build is several backup systems and other systems that can eliminate some of those issues, or perhaps close your orders straight away when you have them in the market through a different server, through a different system. So it really depends what you build or what you're currently running. So there's another question. Um, I think I've got a winning trading strategy. How do I make sure it will really work in the real market? Well, that's a really, really good question. And again, it's there's no straightforward answer to that. How can you make sure that a winning trading strategy really works? Now, there's several ways to do that. Probably the best way is if you have the trading strategy and somehow the strategy is able to execute on small volumes. I would encourage you to basically switch it on, start it on the smallest volume possible, and see if the trades make sense. So if it runs, and then you get your trades back, then you can compare the trades with your backtest and what you would expect from your trading strategy, and see whether they are more or less the same. I can tell you from experience that depending on what strategy you run, they're not always exactly the same. There's always little things that can be different, and it's not straightforward and easy necessarily, or even important to have them exactly the same. But you can basically see once you start running it that what you are running is really good. And then, of course, the other problems, knowing whether a strategy is good or not, is to do your testing. You want to do extensive in-sample and out-of-sample testing. There's also other ways to do it. There's, for example, you can build a regression between your in-sample and out-of-sample backtests, but using different parameters, and you can see whether your backtest actually in the in-sample stage informs the performance of the backtest of the out-of-sample stage. So running a linear regression between them and see whether that's actually happening. And then once you've done that, of course, quite a lot of the time, you might still start with a big drawdown. And this is really nothing you can necessarily change. And you need to really trust the system you have developed to really understand and to really go forward. And clearly, even it's an automated system, you still need some guts to actually run it. I hope that answers your question. Next question from Chiang. I'm a day trader. I don't know anything about programming. How would quantitative trading help me to gain an edge? That's really interesting. So you're a day trader. Now, of course, it really depends what sort of market you trade and what sort of strategies you use. But as you probably know, if you read your usual blogs and trading books and so forth, most traders really emphasize that you should have a systematic approach to trading. So you should be really strict with yourself and really systematic. Now, if you're a day trader, most likely you will still act on some sort of gut feeling and impulse, which is good. You know, you understand the market, you know what's going on, and that often can really help you. So, for example, me being mostly quantitative, I would say that machines can only really know so much. So if you are, like, say, a day trader, you might have gone in the morning and get a cup of coffee in your favorite coffee shop and breakfast, and you can see what the world looks like, what the people's faces look like, what sounds do you hear, and so on. And all this will help you to get an idea of what the state of the market is in that during that day, which is something that when you think about it, an algorithm can't really do unless it's like an enormously powerful algorithm. So as a day trader, you have an advantage in that you have a different perception of the world than algorithm. However, an algorithm can do one thing well, and can do it really well. It can test your ideas in the past. It can actually look and say, well, if I had traded this idea very, very strict and systematically over the past 10 years, and I plug in my data set over the last 10 years, would have made it money or not? Now, that may or may not be a good thing. So it's quite possible that he just come up with a strategy that only started working in this very moment. And of course, that would be great. But in a sense, it would, you know, we wouldn't be able to test it in the past. But let's say you have a relatively straightforward strategy, and you know kind of what you want. You can just go look at past data, build a program, whatever that program is, and test it on your past data. Now, if you're a day trader and you have never been exposed to programming, it might look a little bit daunting at the beginning, and you think, oh my God, it's really, really hard. But I can actually assure you that if you start programming and if you just give it a little try and practice a little bit, and maybe you have someone to help you try and practice a little bit, and maybe you have someone to help you play, very quickly you will actually figure out how powerful it is. And there's actually some programming languages that are not too difficult, like Python or MATLAB, or even R, which is a statistical language. And you can use these languages just in a similar way to how you would use your Excel spreadsheets. And if you do a little bit of work, very quickly you will be able to test your trading ideas. And of course, there's quite a lot of blogs and workshops and online resources out there that show you how to do this. There's also trading platforms that you could use, and so on. And of course, there's certain trading platforms actually give you a way to implement your trading ideas or your trading algorithms in an easier way. So, for example, TradeStation's easy language. It's already, the name says easy language. My opinion is not really that easy, but it's probably easier than some other programming languages. And so this would be a good way for you to start. All right, next question. How to come up with a great strategy? Are there some classic strategies that have been tested to always work? All right, well, when you think about it, there is no strategy, or to say a strategy will always work is a little bit of a misnomer, because it really depends on what time frame you're looking at. So let's say you have a strategy that runs over 10 years, and you look at a P&L curve, and it looks like a pretty straight line from the bottom left to the top right. The more you drill into this strategy, you will see that the P&L curve is probably quite bumpy and quite up and down. And if you look further, you will probably see that you also will have quite a few fairly sizable drawdowns in some cases. And the question then is, well, does this strategy work or not? And yes, of course, it works in the long run if you're trusting it. But if you, let's say, started your strategy and you jump straight into a drawdown and you lose, say, 10 or 15%, you might get the feeling, oh, it actually doesn't work. Or maybe you get into a drawdown and you stay there for like quite a length of time, and you go, ooh, strategy is not working. So it's really a question what time frame you're looking at when you look at the performance of a strategy. And it's not necessarily obvious that this strategy is a winning strategy or not. You can really only assess that maybe after a year or 2 years. It really depends also how fast you are trading. So if you're trading every 2 seconds, then of course after a few days you will be able to tell. But if you, let's say, trade only once a week, it could take a year or two before you can actually tell whether your strategy is profitable or not. All right, next question. How important is financial education? I am a data scientist. Do I have an edge doing quant trading? My background, I don't know all the financial theory yet. All right. Okay, you're a data scientist. You don't know all the financial theory. Now, I'm a scientist myself. I have done a PhD in physics. So when I started, I didn't know any financial theory. Now, it's definitely possible to somehow get into quant trading, but my personal belief is that you really do need some financial theory. Now, I don't think you need a formal financial education, specifically if you have a good scientific, perhaps, or engineering background. You can learn a lot from books, and you can read the books and you see all the mathematics in it, and you can understand it, and you can learn a lot from all those different resources as well. And first and foremost, if you have a data science background, I would really highly recommend to get into the market. Even if you get into the market with a small volume and just do a few trades to understand what's going on. And I can tell you, you will be in for a few surprises. It's not always straightforward what you can see in the market. And yeah, I think it's really important to know a little bit what the markets are doing. I see a lot of specifically data scientists. They get some market data from Yahoo or Google, and then they just run their machine learning or AI algorithms over the market data. And they do a lot of things like data smoothing and run it through some convolutional neural networks, put some LSTMs on top, and reinforcement learning for parameter optimization, and some wavelet transform to smooth the data and all that sort of stuff. But perhaps what they didn't realize is, let's say they work with open, high, low, close data, that the actual open during the day, like say in the US equities market, is extremely volatile, and you got big spreads. And those data scientists, they may not even have heard of the idea of a spread and that it can change. And so they might build a system which looks like it's really raking in money on paper, but in reality, it actually really loses big time, because they have actually forgotten some really essential ideas in the market, which you need to understand in order to really be successful. And so this understanding often comes with experience, by actually doing trades in the market and seeing what's going on, talking to traders, and basically learning your trade one way or the other. All right, so today is only a little test. So I have one more question, and then we will close this session off. So the final question that I would like to answer: what are your favorite performance metrics, and how to use them correctly? All right, what are my favorite performance metrics? Favorite performance metrics, that's a really hard one. Obviously, I really do like the Sharpe ratio, which is the mean of your strategy returns divided by the standard deviation of your strategy returns. It's also called the risk-adjusted return. And it's a great measure because if you get a return, say, of 10%, but you've got a 2% drawdown versus a return of 10% with a 100% drawdown, that even though you end up with the same return, that the two equity curves are really not the same thing. And you would really, one strategy you would feel really comfortable, and the other strategy you would basically get a stomach ulcer after a very short period of time. And so Sharpe ratio is really good. Another one which is really important as a performance metric is profit per trade. So every trade gives you a profit, and when you specifically when you backtest your strategy, quite often, it might look really good on paper, but what the profit per trade tells you is how much money per trade do you actually make, and do you actually make more money than you pay in commission and spreads and so on. And a lot of people, when they get started in quant finance, they completely forget about that. And then they build this wonderful strategy, but what they don't realize is, oh my God, I have to pay commission, and then the commission completely crushes the performance of my strategy. That happens a lot. And it's also interesting because different exchanges, they use different measures of calculating commission. So for example, some exchanges, you pay a certain percentage or a certain number of basis points per trade, which is number of based on the price of the asset. Whereas, for example, in the New York Stock Exchange, you pay a certain amount of money per share, which means if you trade really, really low priced shares, then your commission per asset will actually much, much higher in percentage terms than if you trade a stock that costs $1,000 or so, like Amazon or something like that. And so this is incredibly important, and you really need to use. So profit per trade is a good one. Another one that I use is and I like is profit factor, which is basically the wins divided by losses, and it gives you a good idea of how profitable your strategy is and how good it is. And of course, there's lots more. So there's one more question here, and I just quickly want to answer this from Amit. Thanks, Amit, for popping in. We didn't expect that to be many people, because this was literally just a test we put on this afternoon. And thanks for popping in. I hope you enjoyed this little test. So you asked, how do you select features? Hey, hey, I mean, so this is an interesting question, because again, whilst I'm a scientist by trade, and I'm very systematic and so on, there's also a discretionary element to feature selection, and there's a few interesting parts to that. So one is the trade frequency. So for example, if you say have a strategy that trades really fast, like in the 1 second range, if you had input features like, the current interest rate or something like this, they would basically have no influence on your trading strategy, because they change every few months. How could this really inform your strategy? It's pretty much not a good idea. Whereas, if you, for example, look at the current correlation on a tick by tick basis to the other instruments in your sector, that might actually have a very strong influence on your performance. Now, when you select features, there's a few things to consider. So one is that you, when you find a good feature, you can calculate what you call the information coefficient, which is basically the correlation between your feature value and a forward return. So what that means is, for example, if your let's say your feature value is +1, and you get a positive forward return. So let's say a return in the next 5 days is also 1%. And then your future value goes to, say, -1. And then the return in the next 5 days will be -1%, and so on. So there's a good correlation between your future value and your forward returns. That's also that correlation coefficient. In fact, it's the rank coefficient. Is called the information coefficient. And what you do is when you select features, you look for a good information coefficient. The other thing you need to consider is if you have several features, if these features are quite correlated with each other, you might decide to not use all of these features, or to do some other thing in order to avoid a correlation. Because if you have one feature and then the other feature is highly correlated, then you may as well not use it. It actually creates more problems than anything. So you could, for example, do principal component analysis in your features and just reduce the dimensionality of your feature set a little bit and still retain some of the information of those correlated features. All right, there's another question. What was the name of the coefficient? Oh, it's the information coefficient, the IC. It's basically also called the Spearman rank correlation. So it's basically the coefficient that falls out when you rank your values, and then you run a regression on this. And it's the Spearman rank correlation. That's the information coefficient. So again, that's a really interesting one. Yeah, when you select the features, so please be sure that they're not super highly correlated, because it doesn't really help you. If you have two of the same. You can, of course, also use different features for the different instruments you trade. The issue there is you could easily fall into a selection bias. So if you just test 200 different features, and some of them work on one instrument and then others work on another, you could just end up just selecting the features that just coincidentally work, and not actually get a really good result going forward. So that's something you've got to be really mindful of. So there's another question. These would be different from the feature importance in RF. Yes. So feature importance is a little bit different. So it's actually a different measure than say information coefficient. And yes, feature importance is also something you can use in if you have a machine learning system. And I tend not to use that, because it's you gotta understand that time series are generally a little bit different from what you normally do in machine learning, because time series are usually non-stationary systems, and they have a very high level of noise, so they behave quite differently. And what often happens is when you do some machine learning in it, the machine really starts learning spurious features, basically noise. And in fact, when you create a random price series just using a random number generator, what actually happens is every single random price series you produce, there's very, very obvious features in there. So you produce a random series and you give it a technical analyst, and they will see, oh, look, there's a perfect trend, there's a channel, there's a head and shoulders pattern, or some triangle or something. There's always some features. And machine learning systems can often also learn and identify these features, but in fact they're just random noise. They're not real features. And it's really tricky to find the right way through this. And often machine learning isn't necessarily always the best choice. Sometimes much simpler ways are much better and more profitable. Um, I guess um, there's no more questions. So I will close this session for today. Thanks very much for attending my test session. I really appreciate it. I hope you enjoyed it, and I see you at the next one. Oh, there's one last question. All right, since this is just a test, I'll answer that. Um, Other than returns and volatility, what are other quantifiable variables that have good predictability? Um, so that's a really good question. What are other things that have a good predictability? Well, actually, returns are probably pretty hard to predict. So when we run trading systems, we usually, if we have a predictability just over 50%, we're already pretty happy. Volatility is in fact a little bit easier to predict. Why? Because volatility is mean reverting. So when you have a really high volatility, it's most likely coming down sooner or later, or if it's really low, it's going up again sooner or later, which we've seen in the recent COVID scenario. So volatility is actually, in fact, generally easier to predict than returns. Another thing that, for example, could be predicted, and this can be useful for options trading, is a probability distribution of returns going forward. So as you probably know, or if you might know, that the price of an option is based on a normal distribution of asset returns of the underlying asset. But it's well known in financial in finance that this assumption isn't really correct, and in fact other probability distributions are more appropriate. But those other distributions are often harder to use when it comes to options pricing. So what I found is that if you run through those, you can actually find a decent way of predicting probability distributions. And what that does is it helps you with your options pricing. Now, that's a fairly mathematical undertaking, and it's not straightforward, but it can be fairly profitable because, for example, if your normal distribution says because it has less fat tails, so your option has an implied volatility, and your distribution says, oh, there's an X percentage that the option will expire in the money. But you run another distribution that you deem a bit more accurate, and you say, oh, your distribution, your probability for the option to expire in the money is a bit lower. You could say, well, I can maybe sell the option, and collect the premium because the option is essentially overpriced in terms of what I can see in the market and what the option pricing actually suggests. So that's another thing that is predictive. So really, that there isn't, that there's other things. Perhaps you could predict earnings surprises. So instead of predicting returns, you could predict earnings. That's another thing that might be possible. But there's only so much you can do. We end up usually all using the same values to be predicted. All right. So thank you very much for the session. I really appreciate you listening. As I said before, this was just a test to see whether it was good. I would actually value your feedback if you have any, whether there was something I could change, because what I would like to do is make these sessions public. This one wasn't announced anywhere, so I'm surprised that some of you actually attended. And if you have any feedback for me, I'm more than happy to take it on board, because next time I will announce it publicly, and there will certainly be a lot more people attending the session, and so will be a lot more public. Amit, thank you for enjoying my session. I really appreciate that. That's great. And yeah, thanks very much for coming. Thanks for the questions. And I hope to see you next time for the next session. Please check out LinkedIn. This is where I will announce it. Okay, so then have a good day or good evening or good morning. And I will see you soon. Bye bye.